In the world of investing, two things are vitally important: how an account is titled and how it is taxed. Now, there are two major ways in which investments are titled. They can be either qualified or non-qualified. Additionally, there are four ways in which investments are taxed: taxable, tax-deferred, tax-free, and tax-free squared. Now, for purposes of this video, we're going to kick the fourth bucket and just focus on the first three. So, let's begin with the qualified account bucket. Now, these are generally designed for retirement savings and follow strict IRS rules. They include employer retirement plans such as 401k and 457 plans. Also in this bucket are IRAs. Now, most of these accounts are tax deferred, which means that you pay tax on the growth inside of the account later. The other way to title assets is non-qualified. Now, most non-qualified accounts are currently taxable. You receive a 1099 from your bank or brokerage firm annually and include that income on your tax return. There are, however, exceptions to these general rules. One of them is U.S. savings bonds. The interest on these bonds grows until you eventually cash them in. Therefore, they belong in the tax-deferred bucket. Another item to be moved to the tax-deferred bucket is a non-qualified annuity. Now, this is probably the most confusing, since a deferred annuity can be either qualified or non-qualified. However, no matter how you title the annuity, it belongs in the tax-deferred bucket. Now, the difference in tax treatment is how the money is taxed when it's withdrawn. If an annuity is held inside an IRA, 100% of the withdrawals will be taxed, since in most instances you received a tax deduction when the money was placed in the IRA. With a non-qualified annuity, only the growth in the account is taxed when it is withdrawn. But what about the third bucket, the tax-free assets? Well, to fill up the third bucket, we're going to move some items from both the qualified and the non-qualified buckets. Now, the first item to move is a Roth IRA. This is a tax-qualified account, but all the gains inside of the account are tax-free. The second investment is municipal bonds. Now, these are held in non-qualified accounts, but the interest earned is also tax-free. The third tax-free investment is also the least understood: life insurance. Now, life insurance policies are also non-qualified, but the growth inside is tax-free. Now, many people think of life insurance as a relic from the past that they wouldn't consider as part of their portfolio. However, life insurance can be structured to provide tax-free growth, retirement income, and liquidity for long-term care needs. In my opinion, it's a vastly underutilized investment option. Now, it's important to pay attention to the types of assets that are held in qualified or non-qualified accounts, and to migrate assets into the tax-free bucket if it is at all possible. Now, if you would like to explore more tax-favorable options for your investments in a strategy session and portfolio review, please give our office a call at 480-503-0050. And for help understanding the differences between qualified and non-qualified accounts, click here. To learn more about the four tax buckets, click here.